Business process, applications and controls. Part 1, condensed. In modern business, organizations thrive on systems and processes. Every transaction, employee action, and flow of money or material follows a structured path. While strategy defines what a company aims to achieve, it is processes, supported by applications, that define how those goals are met. This is where business process applications become indispensable. Traditionally, businesses ran on manual methods, a shopkeeper noting sales in a ledger, payroll calculated by hand, or accountants reconciling books at month's end. These methods worked in small setups but collapsed under scale, creating inefficiency and errors. The first wave of automation introduced standalone applications for payroll, inventory, or orders. These improved efficiency but created silos, data was scattered, duplication was common, and cross-functional visibility was poor. The 1990s brought a breakthrough: enterprise resource planning, ERP systems. For the first time, organizations could integrate finance, procurement, HR, manufacturing, and sales into one platform. ERP vendors like SAP, Oracle, and Microsoft Dynamics became industry leaders, while mid-market companies turned to tools like NetSuite or Tally. Over time, the ecosystem expanded. Customer relationship management, CRM, Salesforce, Zoho, supply chain management, SCM, JDA, Oracle SCM Cloud, Human Capital Management, HCM, Workday SAP SuccessFactors, specialized financial reporting tools for compliance. Today, the shift is toward cloud-first, AI-enabled SaaS solutions. Applications integrate seamlessly, leverage predictive analytics, and enable real-time decision-making. Tools like Salesforce, Workday, and Coupa exemplify this modern trend. Organizations rely on these systems for 5 major reasons: efficiency and standardization. Automating repetitive tasks reduces manual effort and enforces consistent workflows. Data integrity and insights applications create a single source of truth, ensuring accurate, real-time reporting. Scalability. They can handle growing transaction volumes without proportional increases in headcount. Compliance and governance. Embedded controls support laws like SOX, GDPR, and tax regulations. Risk reduction. Automated checks minimize fraud, errors, and inefficiencies. Without these systems, most enterprises would struggle to operate effectively. To understand their importance, we must look at the core business cycles they support. Order to cash, O2C, manages the revenue cycle from customer order through invoicing and payment collection. ERP modules like SAP SD or Oracle Order Management handle order entry, credit checks, shipping, and billing. Procure to pay, P2P, covers purchasing activities, requisitions, purchase orders, goods receipt, and vendor payments. Systems like SAP MM or Oracle Procurement streamline supplier management. Record to report, R2R, ensures accurate financial reporting through journal entries, reconciliations, and consolidations. Modules like SAP FI or Oracle GL provide real-time transparency. Hire to retire, H2R, manages the full HR lifecycle, including recruitment, payroll, performance, and retirement. Tools like Workday or SuccessFactors dominate this space. Inventory and supply chain ensures timely availability of raw materials and finished goods. Applications manage forecasting, logistics, and vendor collaboration. Industry-specific processes, specialized applications, power industries like banking, core banking systems, healthcare, hospital management, and telecom, billing and CRM platforms. Each cycle is mission-critical. If poorly managed, it introduces risks: financial loss, fraud, inefficiency, or non-compliance. This is where controls within business process applications matter. They ensure that every step, from order approval to vendor payment, is governed by policies, validations, and audit trails. Controls safeguard against errors, protect assets, and ensure compliance. Business process applications and controls. Part 2, condensed. In Part 1, we explored the foundations of business process applications, their evolution, and the core cycles they support. In this part, let us dive deeper into the categories of business process applications, how they function, why they matter, and how integration creates the digital backbone of modern organizations. Though broad in scope, business process applications typically fall into 6 main categories. Enterprise resource planning, ERP, customer relationship management, CRM, supply chain management, SCM, human capital management, HCM, financial and compliance applications, industry-specific applications, Let's look at each. 1. Enterprise Resource Planning, ERP. ERP systems are the core of most organizations. They integrate finance, procurement, HR, inventory, and sales into a single source of truth. Leading ERPs include SAP S/4, HANA, Oracle ERP Cloud, Microsoft Dynamics, and NetSuite. Key strengths: integration, cross-functional modules connect seamlessly. Standardization, uniform processes across regions, real-time data, instant updates for decision-making. Controls, approval workflows, segregation of duties, audit trails. Example: in SAP, a sales order triggers production planning, inventory checks, and finance postings automatically, reducing errors and manual effort. 2. Customer Relationship Management, CRM. If ERP manages internal functions, CRM focuses on customers. Tools like Salesforce, Zoho, and Dynamics. CRM manage leads, sales, service, and marketing. Key strengths: tracks sales pipelines, provides 360 degrees customer insights, automates marketing campaigns, improves customer service response times. Example: a sales lead updated in Salesforce is instantly visible to finance for forecasting and marketing for targeted campaigns. 3. Supply Chain Management, SCM. SCM systems optimize the flow of goods and services from suppliers to customers. Examples: Oracle SCM Cloud, SAP SCM, Blue Yonder. Key strengths: inventory optimization, demand forecasting, real-time shipment tracking, vendor collaboration. Example: a retailer using Oracle SCM Cloud can forecast festive demand, adjust stock levels, and ensure timely supplier shipments. 4. Human Capital Management, HCM. HCM applications manage the entire employee lifecycle. Leaders include Workday, SuccessFactors, and Oracle HCM Cloud. Key strengths: recruitment and onboarding automation, payroll and benefits integration, performance management and promotions, training and compliance. Example: when a new hire is entered in Workday, their data automatically flows into payroll, benefits, and system access, ensuring accuracy and compliance. 5. Financial and compliance applications. While ERP covers core finance, specialized tools address compliance and advanced financial processes. Examples: Blackline, SAP GRC, Hyperion, Anaplan. Key strengths: automated reconciliations and journal entries, regulatory compliance, SOX, GDPR, tax laws, risk management dashboards, clear audit trails. Example: Blackline automates account reconciliations for multinationals, flagging exceptions and reducing audit effort. 6. Industry-specific applications. Many sectors need tailored systems. Banking, core banking platforms like Finacle or Temenos. Healthcare, hospital systems like Epic or Cerner. Retail, POS and analytics platforms. Telecom, billing and CRM systems. Energy, asset management and SCADA tools. These embed industry-specific workflows and compliance standards. In modern enterprises, no system works alone. ERP, CRM, SCM, and HCM are integrated to share data and streamline operations. Examples: a Salesforce sales order flows into SAP ERP, triggering production planning. Hiring an employee in Workday provisions payroll and system access. Inventory shortfalls in SCM trigger purchase orders in ERP. Integration prevents duplication, enhances accuracy, and strengthens internal controls. Business process applications are now central to digital transformation, going beyond automation to strategic advantage. Cloud ERPs like SAP S/4, HANA Cloud reduce overhead. AI in CRM predicts churn and suggests next best actions. Blockchain in SCM improves transparency and trust. RPA in finance automates reconciliations and journal entries. They are no longer just operational enablers, but tools for innovation and competitiveness. Business process applications and controls. Part 3. Condensed. In Part 1, we introduced business process applications and their role in organizations. In Part 2, we explored the main categories: ERP, CRM, SCM, HCM, finance, and industry-specific systems. Now, in Part 3, we turn to something even more critical: controls. Controls are the safeguards built into business process applications. They ensure every transaction is accurate, complete, and compliant. Without them, applications could enable fraud, errors, or violations. A control is a policy, procedure, or automated function that ensures objectives are met and risks reduced. Examples: an ERP blocking POs above $50,000 without approval, payroll systems calculating taxes automatically, CRM tools preventing duplicate customer records. Controls make processes not just efficient but also secure and reliable. Controls exist to ensure accuracy, transactions recorded correctly; completeness, all valid transactions captured; validity and authorization, only approved, genuine transactions processed; security, sensitive data protected; compliance, activities aligned with laws and policies. These objectives support financial reporting, efficiency, and regulatory confidence. Types of controls: 1. Preventive, detective, corrective. Preventive, stop errors up front, for example, credit checks before sales order. Detective, identify issues after occurrence, for example, duplicate invoice reports. Corrective, fix detected errors, for example, adjustments after reconciliation. A balanced control environment uses all three. 2. IT application, manual, configurable IT application controls, ITACs, automated checks like three-way matches, payroll tax deductions, or system-calculated depreciation. Manual controls, human reviews, reconciliations, or exception handling. Configurable controls, system settings such as SAP approval limits or password rules. 3. ITGCs versus business process controls, IT general controls, ITGCs, broader system-level controls like access, backups, and change management. Business process controls, transaction-level safeguards ensuring accuracy and validity. Think of ITGCs as the foundation and business process controls as the locks and alarms inside the building. Examples across business cycles: order to cash, O2C, credit limit checks; segregation of duties for order creation versus credit approval; automated invoice generation; procure to pay, P2P; vendor master approvals; three-way match before payment; duplicate invoice checks; record to report, R2R; segregation of journal entry preparer versus approver; automated reconciliations; locked accounting periods; hire to retire, H2R; role-based access for new employees; payroll accuracy checks; automatic deactivation upon termination; supply chain and inventory; authorized stock movements only; periodic physical versus system stock reconciliations; segregation of duties in procurement, inventory, and payments. Why controls matter? Controls are essential because they reduce risk of fraud, errors, inefficiencies; ensure compliance with laws like SOX; enable auditability via reliable trails; protect integrity of financial statements; boost efficiency by automating checks. Case examples: weak P2P controls. An employee creates a fake vendor, processes invoices, and pays themselves, a common fraud where vendor master approvals are missing. Weak termination controls. Ex-employees retaining access have executed unauthorized transactions, exposing companies to financial and reputational loss. Such cases highlight why strong business process controls are non-negotiable. Business process applications and controls. Part 4, condensed. In earlier parts, we explored what controls are, their objectives, and importance. Now, we focus on how controls operate in key transaction cycles, the backbone of every organization. When auditors and risk professionals test internal controls, 4 core cycles dominate: order to cash, O2C; procure to pay, P2P; record to report, R2R; hire to retire, H2R; business process applications and controls. Part 5, condensed. In earlier parts, we explored business process applications, core cycles, O2C, P2P, R2R, H2R, and their controls. Now, we shift to advanced controls, the connection with ITGCs, and how auditors validate effectiveness. Business process applications and controls. Part 6, condensed. We've explored business process applications, controls, ITGCs, and audit testing. In this final part, we consolidate with best practices, real-world failures, and the future of controls in a digital-first world. The future of controls. Business process controls are rapidly transforming. AI and ML spot anomalies in vendor payments or payroll. RPA, bots perform reconciliations and approvals but must be governed. Blockchain and smart contracts, immutable records and automated enforcement. Cloud ERPs, SAP, Oracle, Workday, compliance built in but with new shared responsibility risks. Continuous control monitoring, CCM. Dashboards allow 100% transaction testing in real time. Cybersecurity integration. Controls now extend to MFA, identity governance, and frameworks like NIST or ISO 27001. Business process applications and their embedded controls form the foundation of modern enterprise operations, ensuring accuracy, compliance, and strategic advantage in an increasingly digital world.